Good afternoon, everyone. Welcome. It's been a very busy week, as I'm sure you're all aware. The MPC was slightly disrupted in that there was a parliamentary committee hearing by the finance committees on the Reserve Bank amendment, which was on Wednesday. So in fact, we had started, as I'd indicated previously, we've started our MPC meetings on Tuesday afternoons to allow more time for discussion. This time we started early on Tuesday. We then broke on Wednesday and reconvened on Wednesday evening, so that just to indicate that the MPC did its full amount of work, plus we just went to Parliament in between. But it's an indication that we had a lot to do this week and it certainly spent the due amount of time that the MPC needed to consider the issues. In essence, the outlook for domestic inflation has remained favorable, and inflation is still expected to remain within the target range over the forecast period. Domestic economic growth prospects appear to have improved, and most growth forecasts have been revised upwards. However, the risks to this relatively favorable growth outlook have emerged as a result of recent global developments. These risks include uncertainty relating to the sustainability of fiscal deficits in a number of euro area countries, reaction from the financial markets to these events, and this has raised new fears of possible contagion which could derail the recovery. The recent developments in inflation show that the year-on-year inflation rate as measured by the Consumer Price Index for all urban areas declined to 5.1% in March 2010 from 5.7% in the previous month. The category of housing and utilities remained the single biggest driver of inflation, mainly as a result of the impact of a 26.8% year-on-year increase in electricity prices. There are a number of other significant outcomes. Food price inflation increased by 0.5%. Administered prices, excluding petrol and paraffin, increased by 10.4%, down slightly from the 10.8% in February. Producer price inflation increased to 3.7% in March 2010, compared to 3.5% in the previous month. However, this upward trend is mainly driven by primary commodity prices that do not impact on CPI, and food price inflation at the producer level continued to decline and should constrain food price inflation at the consumer price level in the coming months. The outlook for inflation, therefore, in terms of the CPI forecast of the bank, indicates a slightly improved outlook compared with that presented at the previous meeting of the MPC, with a lower projected inflation for 2010 and 2011. CPI inflation is still expected to reach a low point in the third quarter of 2010, when it's forecast to average 4.7%. Inflation is then expected to increase moderately and remain within the inflation target range until the end of the forecast period, which has been extended to the end of 2012. Recent surveys of inflation expectations indicate that inflation expectations of analysts are within the inflation target range for most of the forecast period. Inflation expectations, as indicated by the inflation-linked bonds, also reflect an improvement since the previous meeting of the MPC and are within the inflation target range. We are seeing that the global recovery has also been gathering momentum. According to the World Economic Forum outlook published by the IMF in April, global growth is now expected to average 4.2% in 2010, compared with the October 2009 forecast of 3.1%. However, the recent developments in Europe have raised the possibility of a renewed crisis that could threaten global recovery. The reaction of the financial markets to the downgrading by the rating agency of some euro area countries was reminiscent of the aftermath of the collapse of Lehman Brothers in September 2008. Apprehension about a possible default on Greek sovereign debt sparked concerns of a contagion effect on other European economies with high fiscal deficits and debt ratios. There were also fears of a spillover to the European banking sector, which has significant exposures to the sovereign debt of these countries. European banks have exposures of about $2 trillion to debt of Greece, Spain, Ireland, and Portugal. The sharp reaction impacted on exchange rates, bond yields, equity prices, credit spreads, and interbank markets, and so on. Fortunately, South Africa saw no impact on the interbank market. The financial markets initially reacted positively to the concerted and significant policy interventions announced on the 8th of May. However, the markets were subsequently less convinced that these moves would be sufficient to resolve the underlying solvency problems of these countries, or that the required fiscal consolidations would be politically and socially feasible. It is estimated by some that Greece's GDP will contract by at a cumulative 16 to 20% over the next few years if the proposed adjustments take place. These developments demonstrate the fragility of the global environment, and the related uncertainties pose a downside risk to the global recovery. The global inflation outlook, however, is expected to remain benign and is not expected to pose an upside risk to domestic inflation. For much of the period since the previous MPC meeting, the exchange rate of the rand had remained relatively stable, within a range of around R7.23 and R7.48 to the US dollar. However, the turbulence in the global financial markets resulted in a brief but significant depreciation of the rand against the dollar as risk aversion returned to the markets. Non-residents became net sellers of bonds and equities, and on Thursday, the 6th of May, the rand depreciated by 1.6% to R7.74 against the US dollar. During the New York trading session, it depreciated further to R7.95. Following the announcement of the proposed government interventions in Europe, the rand appreciated to current rates of around R7.50 against the US dollar. The behavior of the rand exchange rate during this recent period demonstrated the continued vulnerability of the rand to changes in global sentiment. The rand was not alone in being affected by the heightened risk aversion. On the 6th of May, for example, emerging European currencies depreciated between 1.6% and 3.4% against the dollar. The Australian dollar depreciated by 1.7%, and the Brazilian real 2.8% against the US dollar. Most recovered after the announcement of the package, but these responses illustrate vulnerability. During a crisis, funds flow to the US dollar. On a trade-weighted basis, the rand is relatively unchanged since the beginning of the year. Over the same period, the rand has depreciated by over 1% against the US dollar, but has appreciated around 11% against the euro. At current levels, the rand remains a positive factor in the inflation outlook, but this can be affected by developments in the euro area as well as general risk aversion. The global developments also highlight the current focus of the financial markets on the sustainability of fiscal deficits and debt ratios. The South African national government deficit measured an estimated 6.7% of GDP in the 2009-2010, compared with a projected 7.2% announced in the February budget. The deficit is expected to narrow over the next 3 years as the economy recovers, and to measure 4.7% in the 2012-2013 fiscal year. The overall government debt to GDP ratio is expected to peak at 43% in the medium term. This fiscal trajectory is consistent with fiscal sustainability, and the MPC does not foresee a possible conflict with monetary policy objectives should the trend be maintained. The moderate recovery in domestic economic growth appears to be sustained. This is confirmed by both the composite leading and coincident business cycle indicators of the bank. The various business confidence indices are also relatively favorable. The most recent GDP forecast of the bank is for growth of 2.7% in this year in 2010 and 3.6% in 2011. At these rates of growth, the output gap is not seen to be an upside risk to the inflation outlook. The main risks to the growth outlook are seen to emanate from possible adverse global economic developments. The growth outlook is underpinned by the continued recovery in the manufacturing sector, which grew at a broad-based year-on-year rate of 6.3% in March. The Kagiso BER Purchasing Manager Index declined in April, but nevertheless reflects continued expansion of this sector. Total mining production increased at a year-on-year rate of 11% per annum in March. However, private sector demand pressures remain benign from an inflation perspective. There is some evidence of an improvement in household consumption expenditure. Real retail sales declined on a year-on-year basis in February, but the shorter-term trends were more favorable. When the 3 months to February are compared with the previous 3 months, an increase of around 3% was recorded. New vehicle sales also maintained their favorable trends, increasing at a year-on-year rate of 36% in April. Domestic bank credit extension to the private sector continues to reflect weak demand conditions, despite evidence of some loosening of credit supply constraints. 12-month growth in loans and advances contracted by 0.3% in March 2010. Growth in mortgage advances declined from 3.9% in February to 3.6% in March, but remained the only category of credit extension to register positive growth. The most recent Ernst & Young BER Financial Services Index shows that the banks have moved to a more neutral position with respect to credit standards applied to new loans. Consumption is also determined to some extent by the wealth effects in the economy, and house prices appear to have recovered somewhat, and the various indices now all reflect positive house price growth. The equity markets have also improved significantly since their lows in March 2009. However, in the 5 trading days to the 7th of May, the JSE All-Share Index declined by almost 10%, demonstrating the vulnerability of the market to changes in sentiment. Despite the more favorable growth outlook, employment trends appear to be lagging the domestic recovery. The quarterly labour force survey indicates that 171,000 jobs were lost in the first quarter of 2010. These adverse trends are expected to constrain household consumption expenditure somewhat, and offset to some extent the positive impact on consumption of higher real wage increases. Notwithstanding the job losses, there is a concern about the possible impact of the level of wage increases in the economy. According to Andrew Levy Employment Publications, the average wage settlement rate in the first quarter of 2010 moderated to 8.4% compared with a 9.3% increase measured in 2009. However, the MPC noted that a number of wage negotiations are at significantly higher levels and well above the current and expected inflation rate. Should a general upward trend in wage settlement rates transpire, in the absence of competing increases in productivity, it could pose an upside risk to the inflation outlook. Other factors that have a significant impact on the inflation outlook include food and petrol prices. As noted earlier, food price inflation is expected to remain subdued as a result of the recent decline in the domestic maize price and falling prices at the producer price level. The international oil price, having remained in the range of $70 to $80 per barrel for some time, appeared to have resumed its upward trend since late April. The recent uncertainty in financial markets, which cast doubts about the sustainability of the global recovery, resulted in a decline in the international price of Brent crude oil to below the $80 a barrel level. The main upside risk to the inflation outlook continue to emanate from administered price developments. Taking the above into account, the assessment of the Monetary Policy Committee is that inflation is likely to remain within the inflation target range over the forecast period, and that the economy is expected to continue on a recovery path. The risks to the inflation forecast are seen to be more evenly balanced than at the previous meeting of the MPC. The main risks to the inflation outlook emanate from administered price developments and from the risks emanating from the global economy. The domestic growth outlook will continue to be affected by global developments. The MPC will continue to monitor these developments closely, and for these reasons the MPC deems it appropriate to maintain the current stance of monetary policy. Accordingly, the repurchase rate remains unchanged at 6.5% per annum. Thank you. I'm happy to take any questions, and I and my colleagues will field them. I think you have a microphone now.
Hi, Vernon Vessels of Bloomberg News. I know you guys usually debate the decision. Was there differences of opinion over where the rate should go? Was there any arguments to cut the repo rate?
No. The committee members were unanimous in their views. I don't think there was any discussion about cutting at this point in time. I think the real focus was on the unknown factors of what is going to be happening in Europe and the impact or the possible impact on the South African economy, and trying to understand that. So a lot of time was spent unpacking those issues. But a unanimous view. Miriam?
Thank you. Mary Lisa from Business Day. What kind of concern is there if the global economy should have another lurch from this debt crisis? Would this have a real effect on the South African economy? And how do you expect it to manifest itself? My other question is, when do you expect the investment rate to turn positive? The bank's last quarterly bulletin showed that it was negative in the last quarter of last year.
I'm certainly going to be asking my colleagues to participate more this time. So perhaps in terms of the effect of the global, who would like to take that one up?
Well, I think it's important not to be complacent about the likely impact of international developments on the South African economy. On the other hand, one doesn't want to be alarmist. So I do think that we saw towards the end of last week some indication of the manner in which the economy could be impacted. And I think the view that is taken is that the best defense in these circumstances is to stick to sensible policies.
Investment rate? Monday?
I really didn't get the question. Is that the investment ratio that turned to be negative? What is the
I don't know if you can hear me. The question was, when do you expect growth and investment to be positive again? I think it was negative in the final quarter of last year. Are there any signs that gross fixed capital formation has picked up so far this year?
Well, I don't think we have an indication of what is going to happen with the investment, with the growth in fixed capital formation, but based on what has been published, from the government side, we would expect going forward 2011 and 2012 to be positive. If it was negative, yes, it was negative in the fourth quarter, but we don't expect it to continue that way, as there are a lot of infrastructure projects that are coming in place, so we would expect it to be positive going forward.
I think there was a hand here first. You answered?
Hi, good afternoon, Governor. Renée Volgra from Soccer 24. I want to know, what does the committee expect? Does the committee expect the rand to keep trading in the current band that it is in, or does it expect the global downturn to have a more severe impact on the currency?
Daniel?
That's a very difficult question. I don't think the committee certainly does not know. And as we have seen in the last few days, conditions can be very volatile, and certainly which trading range one could expect for the rand going forward will depend on a whole host of factors. It's a very, very difficult situation to look at. What is important, though, from a policy-making perspective, is for the committee to concern itself with longer-term trends as opposed to short-run market movements.
Afternoon, Governor. Candy from Summit TV. Just to follow up on the RAND issue, just to find out, there have been a lot of calls from unions and business to just sort of weaken the RAND. Does the bank have anything planned to actually weaken the RAND? Can we even do anything, or can you do anything? And
You too.
and the last one is, you've kept rates on hold. Could the next move be up?
I think that perhaps I'd like us just to look at this question of the exchange rate and the call there, and perhaps use the Greece example and the difficulties. Who would like to tackle that? Brian?
Well, I think I think what the Greek example has shown is the difficulty or the dangers of moving into a fixed exchange rate type of solution for the country. The problems that the countries in the Eurozone are facing in the whole need for adjustment is that they can't, an important lever that they could have had, which is the exchange rate, is simply not available to them because they can't adjust the exchange rate. So all the adjustment that takes place has to happen on real variables. I think for us the lesson of the European experience is one that trying to fix the exchange rate at a predetermined level is extremely dangerous, and I think there have been other examples such as Argentina, for example, in the early 2000s when they had a fixed exchange rate system and eventually landed them in a very serious crisis, and they had to move away from there. With respect to whether we can weaken the exchange rate, that's a much more difficult question to answer. In the past, we've seen there have been times when we've had a fairly significant amount of purchases of dollars in the market in a month, and it hasn't had a major impact on the exchange rate. And so what that illustrates is that when the markets are favorable towards the country and there's money moving in, it's very difficult to act against that. At the same time, what we saw in the last week is how quickly the exchange rate can move in the other direction. When there's a change in sentiment and a change in risk aversion, the exchange rate can move very quickly as well. So our view is that it's very difficult to try and move the exchange rate in a predetermined way. There are different ways we could try and do it. All of them have problems and are not very easy.
Perhaps just an addition, if you look at some of the discussion around the UK and its difficulties, one of the differentiating factors that they have is because the UK is not part of the euro and they do have the ability to adjust their exchange rate. So it's an important factor and one of the reasons why Britain's a little bit differentiated around the challenges it faces. The question about, but at the same time, while we're looking at that, I think the issues lying behind the call for a fixed exchange rate or for a predetermined exchange rate that is coming there reflect the real concerns about what is happening in the economy. We don't necessarily agree with the answer that they're proposing, as we're indicating, but it doesn't mean to say that the issues that are there don't need to be addressed. And what, again, we would say, it is a combination of what the macro policy can do and what the micro policy needs to do. If you look at the structural situation in our country, there are big structural imbalances that need to be addressed, but that's not necessarily through macro policy. So it is a discussion that is important to be held to understand the huge challenges we face at the structural level in our economy. As for your question about which way would be next, we would be basing that on the data, but all indications are that inflation is expected to remain within the target range. And obviously the risks that we have highlighted can happen very quickly, but the outlook at the moment seems to be a steady outlook. So and we would certainly be influenced by the data.
Tsepo from SABC News. I just want to get the reasoning for the banks to extend the period within which you expect inflation to remain within the target. Because one would wonder, at a time where you've got administered prices, petrol price going up, eventually one would have expected maybe the impact of this to be felt probably by end of the year or beginning of next year, but you expect it to remain within target by 2012. And secondly, maybe just to find out if you are able to say anything on the amendment bill?
Yes, nothing on the amendment bill. That's a different discussion. This is the Monetary Policy Committee. Perhaps in terms of the forecasts and the numbers around the inflation, XP?
Well, I think the forecasting period has to be adjusted. We are now almost halfway through the year. So if you count 18 months ahead, you're going to start to get into beyond 2011 into 2012. And as we move forward, that is the way in which the forecast will continue to be made.
There were other... Yes, sir?
Good afternoon, Governor. My name is Sidney Mudiba, a freelance reporter. Governor, I've got close to 3 questions.
How close?
Okay.
2 and a bit, 3 and a quarter.
Okay.
Go for it.
15 years into democracy, Governor, do you see a radical transformation of the economy in this country? And then another one is, should the Reserve Bank be nationalized in the mines? Do you think this is going to strengthen our rand, especially the exchange rate? And another one is on the bank. How does the Reserve Bank plan to discipline shareholders like Michael Dua, who is trying to make the bank difficult to manage? It has been reported that he once came to an AGM barefooted and dressed in lederhosen. Thank you.
Now, Sydney, this is about the Monetary Policy Committee. There are going to be hearings in Parliament about the bill, about the amendment bill and the issues of shareholders. I really would prefer not to get into that today. I think it is a different discussion. And, I think we have presented the bill to Parliament. And the views that we take have been well expressed there, so I would prefer not to comment on that. On your first question, which is the question of how do we see transformation over the 15 years, I think that, we South Africans, there's a huge challenge to overcome, and I don't think that one should expect this to be done in a very short period of time. There's definitely been, without any question, significant changes in the structure of the economy, in the ownership of the economy. The question asks, is it enough, and are there people who are still out there? Yes, you've got a huge structural problem, as I said earlier. No country with an unemployment rate of around 24 or 25% can be complacent about its achievements. And if one simply looked at that, you've got to look at that in relation to the things that need then to be addressed to deal with that structural problem. Education, all of the kind of things that you support, living conditions, and so on. And therefore, it's a national project. It's not simply a Reserve Bank project. Our job and what we try to do is to create a stable, certain macroeconomic environment within which the microeconomy can change and address the very things that need to be done to build a more sustainable growth going forward. This is a huge national project, and we are part of it, and we'll play our role to the best that we can. There's always room to do more and better. Let's see if there's anyone who hasn't asked. And we can come back in sequence. Vernon?
Thanks, Governor. I was just wondering, with credit, with private credit extension still in negative territory, what role can the central bank actually play in stimulating bank lending? Can you not perhaps, for example, offer banks with one-year money at spot rates as a measure to encourage lending, and rather look at money supply instead of only just interest rates as a means of encouraging bank lending?
I think there are a number of things, but I usually look at it as if there's only one side to that issue. And I think there are very many lessons learned about when credit extension was at the levels that it was, and a number of measures taken, including the National Credit Act, the question of affordability, all of those things. But for there to be credit extended, there needs to also be demand. And what you're seeing with the high levels of indebtedness, that this is a two-sided equation. It's not simply one. As I said earlier in the statement, there appears to be a slight easing from the banks in terms of their credit lending criteria, but at the same time the demand is simply not there. And I think that relates to the high level of household indebtedness, the uncertainties about jobs, the environment that is there. So people are very hesitant, and I think that inducements to extend credit is not necessarily the answer to the issue. I would not think that that is necessarily the way to go at all. I think it's as much that we've got to look at the demand side and the creditworthiness, affordability, huge personal indebtedness. And people are using this opportunity, I think, to restructure their personal balance sheets, their household balance sheets. which is a good thing in the long run. Miriam?
Thank you. The inflation outlook has actually improved, and your forecast for 2012 was quite benign. You say the risks to the outlook are more evenly balanced than last time, and that the main risks are from administered prices and the global economy. Now, the global economy, I assume, is a negative risk in terms of growth if things should go badly there, and administered price developments are a risk in terms of inflation being higher. So I just wondered, I mean, given that they are balanced, is administered prices the main sort of domestic threat at the moment? My second question, it's a bit hypothetical. If there was another global shock, the effects on South Africa would be negative, presumably in two ways. One, it would affect our growth rate, our expected growth rate through exports, and number two, the rand would be likely to weaken, as we saw happen last week. In this kind of scenario, then, you've got a downturn in growth and a weaker rand, which would fan inflation. What kind of how do you think the MPC would look at that scenario?
As you said, Miriam, you're fishing. That's not a question that one can answer. What we've said is that we are watching it very closely. This isn't something that would simply affect South Africa. This would be something that would affect a huge number of countries should the situation go bad. It's precisely why you had the concerted efforts by the European Union Ministers of Finance and central banks, a concerted massive package that should stabilize, and we hope does stabilize the situation. The measures taken, you saw by Spain about cutting civil service pay by 5%, getting their measures in place. So a lot of very, very difficult times ahead. We can't anticipate what impact that would have. And we are optimistic that the measures taken and the discussions being held will help manage the process through to actually start saying we would do this in this circumstance and that in that circumstance. No, what we are saying is we're very alive to the issues and we will deal with it as and when and should they arise. It is not for us to speculate what-ifs in that sense. It would be inappropriate. Yes, sir. Sorry, you had a question on, what was your first part of the question?
Is administered price developments the main risk to inflation?
That's our view at this point. Bearing in mind all the questions that you look at everything all the time. Yes, sir.
On the wage demand, we've seen that with the Transnet strike, unions demanding 15% and Transnet wanting to settle around 11%, ESCOM demanding 18%. Do you think that is sort of setting a bad precedent going forward? And you mentioned that those high demands, if they are not compensated by output, could be a problem. What can be done to improve on that?
I think that you've got the question of improved productivity and lower wage demands. I don't think you can address to us. We're just highlighting those issues. But what we're also saying within that, if you looked at the Levy survey, the trend was downwards, and very nicely downwards before this current spate of wage demands. And what we are pointing out is that inflation is around 5% and expected to hover in that within the band going forward, and stay in the band for the forecast period. What it should influence wage trends down, because that is a reality that people experience. And therefore we're just alerting to the fact that wage demands at these levels, unless accompanied by productivity increases, have a very will have an impact. But it's we're not in the bargaining chamber. Any other questions from anyone? Other contributions? Anything you'd like to add, Bertus, Rimosi? That's it. Thank you all very much indeed. Thanks for coming through to Pretoria and for joining us again today.